All week, I've been warning you to steel yourself for a rough month because historically, September has not been a good time to own stocks. There's only so much you can glean from the calendar, but any veteran trader knows that this tends to be a brutal month. How brutal? To answer that question tonight, we're going off the charts with the help of the legendary Larry Williams. He's a tremendous technician who's been trading stocks, futures, and commodities since I was too young to drive and had a lot of pimples. He's written more than a dozen books, created a host of indicators that we talk about all the time on the show. More than that, though, he's been on a roll for the last year and a half. Ever since the pandemic hit, he's done a terrific job of identifying opportunities, including the boldest bottom call I've seen last spring. Let's talk about September, though. If you like musicals, you can try to take your cue from the Fantastics. Try to remember the kind of September when life was slow and oh so mellow. But that's very hard to do because this is rarely a mellow month for the stock market. Of course, you can't just blindly follow the calendar. Sell in September and go away has a better track record than sell in May and go away, but it's not exactly a rigorous approach to the market. There's not even any alliteration. That said, you need to be aware that tons of traders pay very close attention to what I'm about to show you, very close attention to the seasonal patterns, and they're all gritting their teeth for difficult periods because of what I'm about to show you, unless, of course, they're short sellers, in which case they're licking their lips in anticipation. Ordinarily, I wouldn't be too worried about this kind of thing, but when you layer in the Delta variant induced, look, it's causing a slowdown, let's face it. But you also have the fear of the Federal Reserve, the possibility of a debt ceiling debacle in Washington. September sell-off, let's just say it can easily become what I call a self-fulfilling prophecy. So first, let's circle back to the seasonal pattern and take a look at how the S&P 500 futures contracts have been traded historically. Here's what the seasonal pattern looked like 20 years ago. Yes, 2001. Using only data that we had from the year 2001. This is what Williams calls the true seasonal pattern. He points out that even back then, the charts were warning you that September would be a rough time for the S&P. Obviously, we had no idea, particularly how bad it would be, but it tends to be a dark period for the market, even when we don't get hit with a horrifying terrorist attack. 20 years ago, the seasonal pattern showed weakness in September, and it predicted that weakness would accelerate on 9/17. In retrospect, holding until the 17th would have been a mistake. But if you sold at the beginning of that terrible September, your portfolio would have sidestepped a lot of value. I mean, the traders among you probably want to do that, or you might want to just lighten up and raise some cash. That's what we've been doing for the charitable trust. This is too compelling. How does the seasonal pattern look like today? Now we're going to look at 20 years of additional data to what I was showing. Check it out. This is what Larry's true seasonal pattern looks like today. It's incredible how it holds up. This is using numbers from 1998 to 2001, to the present. Honestly, the pattern hasn't changed all that much. Williams points out that the optimal seasonal sell point continues to be the same, around September 17th. Believe me, on the 16th, you're going to see a lot of selling because of what I'm showing you right now on the 17th. This is when prices tend to experience a precipitous drop. If history's any guide, there's a high probability this market will get hit with a meaningful decline at the end of this month, which is one reason it's been, I think, so soggy for the last week. This stuff is known by a select few. I'm giving it to everybody. If that's the case, when is the best moment to sell in September? Now I'm going to take a look at show you a table which shows how you would have done if you had sold the S&P 500 on the last trading day of September through the 15th to last trading day. I know it's a little tricky, but I'm going to show this to you and walk you through it. In this particular method, he's using a $2,500 stop-loss order and exiting on the first profitable opening after being in the trade for 2 days. So this is pretty short term. I'm going to get behind. I'll move over from this. If you sold on the 15th, the last trading day, okay, so you're looking at the bottom, early in the month, and used this method, you've historically lost a lot of money. Williams points out that the optimal moment to sell the S&P on the 7th to last trading day of September for 23 years, this is it right here. This is when you do it. 23 years has been a winning move. 23, that's extraordinary. Now, if you sold it on the 10th, get this so it's clear. If you sold it on the 10th to last trading day or the 8th to last trading day, you're bracketing this, okay? Those moves had a 90% accuracy, but the sweet spot is still the 7th to last, which translates to September 22nd this year. But that table only shows how you would have done if you only held it for a few days. It doesn't tell us very much. It's more important to know if this pattern has legs, right? So what happens if you sold on the 7th to last trading day of September and then held that trade for longer? Take a look at this table, which shows how you would have done if you pushed your luck and held the trade for 1 to 15 days. All right. Williams points out that when you hold this trade for a longer period of time, you're sacrificing accuracy in order to pursue greater profits. If you bought the S&P futures only a couple of days later, you would have been up 866. Okay, there it is. But that trade has worked every year for $23. So you can make this much on 25, that much every year. That's worked. Okay, 23 straight years. Now, if you hold the trade for longer, say 14 sessions down here, your average gain on winning position was $3,092. But you only made money in 16 out of 23 years. Get the trade-off? All told, if you did this every year for that whole period, you would have had more gains if you only closed the position after 14 trading days. So Williams thinks it's worth the trade-off. I really want you to know this if you're really interested in trading. In short, the late September sell-off clearly has legs. Or to go back to the Fantastics, try to remember, and if you remember, then follow. Here's the bottom line. The charts as interpreted by Larry Williams suggest that the rest of September could be even uglier than the month so far. If history's any guide, then the last week of September might be particularly brutal. So I need you to steel yourself. Because like Mr. T, as Clubber Lang in Rocky III, this legendary technician's prediction is ping. Santo in Florida. Santo!